Let's set up a controlled 20-year timeline. Meet Jake and Marcus. They are both 30 years old, living in the same city, earning the same $55,000 salary. Right now, they each have exactly $50,000 sitting in the bank. The only variable is what they do with that cash. Jake takes his $50,000 and uses it as a 20% down payment on a $250,000 rental property. He takes out a 30-year mortgage at 7% interest, finds a tenant, and locks in the rent. On paper, after covering the mortgage, he is clearing $470 per month in gross cash flow. Marcus takes his $50,000 and puts it straight into a total stock market index fund. He sets up an automatic contribution to invest an additional $300 every month. Then he closes his laptop and goes to work. Over the first year, Jake experiences constant positive feedback. He sees rent hit his account every month. He can physically drive past his property and point to it. Marcus gets an automated email once a quarter. His balance goes up a little, down a little, and up a little. Nobody is impressed at dinner parties when he mentions his broad market index fund. That difference in how an investment feels dictates how people behave. The tangible pride of real estate and the invisible boredom of index funds shape every decision these two will make over the next 2 decades, and those feelings have a direct impact on their actual net worth. Let's fast forward to year 3. Jake's property has brought in nearly $17,000 in gross cash flow. This is the number landlords love to talk about. It looks great on a spreadsheet. But that gross number has to survive contact with reality. Over those 3 years, Jake pays $9,000 in property taxes. Another $4,500 goes to insurance. He loses a month of rent to vacancy, and he has to fix a roof leak and replace a water heater. After real expenses, Jake's actual net profit drops to somewhere between $2,000 and $4,000. And to keep those margins, Jake is managing the property himself. That means late-night phone calls, coordinating repairs on his lunch break, and doing weekend showings. None of that labor appears as a line item, but it costs him hundreds of hours. Yet despite the terrible cash flow and the constant weekend labor, Jake is actually building immense wealth. He used his $50,000 to borrow money and control an asset worth $250,000. Even though Marcus is earning roughly a 10% historical average on his cash, Jake's property only needs to appreciate at 3% annually to generate larger raw dollar gains, because the bank provided most of the capital. This 5-to-1 leverage is the mathematical engine of real estate. The returns don't come from the monthly rent checks. They come from using debt to amplify appreciation, which requires a continuous exchange of personal time and effort to maintain. By year 10, the math shifts. Marcus hasn't taken a single midnight phone call about a broken pipe, but his steady contributions and compound interest have reached a critical mass. His portfolio is now sitting around $170,000. The gains on his early returns are now generating new wealth faster than his deposits. But the stock market exacts a different kind of tool. If Marcus's portfolio hits $150,000 right before a major correction, he might watch his net worth evaporate down to $95,000 in a matter of weeks. This chart tracks market performance over a single month in March 2020, showing exactly what a rapid 34% drop looks like. 12 years earlier, the market lost over a third of its total value during the 2008 financial crisis. When decades of savings vanish, human instinct takes over. Historical data shows that large numbers of retail investors panic sell during these drops. They lock in severe losses at the exact bottom and sit out the recovery. The hands-off math of index funds works perfectly, provided you actually leave your hands off. Generating wealth this way requires the emotional discipline to watch savings plummet and do nothing. At year 20, Jake's mortgage is mostly paid off, and Marcus's steady deposits have grown. They are both sitting on roughly $450,000 in total wealth. Let's run a quick variable change. What happens to Marcus's final number if he had increased his monthly contribution by just $200? By raising his deposit from $300 to $500, the multiplied effect of late-stage compounding pushes his 20-year portfolio up to nearly $600,000. He completely overtakes Jake's real estate equity. Increasing the return on a stock portfolio requires logging in and typing a slightly larger number into an auto-deposit field. Scaling a real estate portfolio requires finding a new property, taking out a second massive loan, and doubling your workload overnight. So how do you decide? Real estate clearly wins if you are in a local market with high rent-to-price ratios. It wins if you utilize tax shelters like depreciation and 1031 exchanges to defer capital gains. Most importantly, it wins if you view it as a part-time job and have the bandwidth to manage the assets. Index funds win if you prioritize simplicity and liquidity. They require exactly 0 hours of property management, 0 physical labor, and provide immediate access to your capital. The only requirement is the psychological endurance to ignore market volatility. The math shows there is no perfect asset. You either trade your physical time and labor to access the power of bank leverage, or you trade your emotional comfort to harness the long-term growth of compounding. Both paths build wealth. You just have to choose which price you're willing to pay.